Welcome to this week's Market Minute podcast. I'm Andrew Wilkinson. My guest today is Kevin Davitt, Head of Index Options Content at the Nasdaq. Welcome back, Kevin.
Thank you so much for having me back. I'm doing great. I hope you are as well.
Yep, for an FOMC conclusion day, I'm doing just fine. At the time of the last meeting in July, Kevin, the FOMC was faced with a 3-month average job growth of 150,000 people being added to US non-farm payrolls. But due to revisions and subsequent weakening in the labor market, that 3-month average has now dropped to about 29,000 jobs each month. How important is today's FOMC outcome for the next episode in the stock market?
So you framed it, I think, in a very interesting way around recent weakness in the labor market. But as far as today, much as we kind of are inclined to make it seem like every Fed meeting is the most important one ever, I doubt it. My expectation, this is just my own, is for a relatively muted reaction because the market has correctly anticipated Fed moves for years now. And I doubt that the Fed does something that puts the whole market kind of off sides. If that happened, all bets are off. So that's my long-winded way of saying, I think today we're going to see a quarter point cut and markets get back to business as usual. Bigger picture, your points about the labor market is well taken.
I think most people in the market are looking for a 25 basis point cut. I'm a little bit different. I'm feeling here that there's no point being just a little. You can't be a little bit pregnant. I'm actually thinking they might go for a 50 basis point cut. And I don't know. Do you think that would it seem like panic, or would it be better for the stock market, do you think?
So I think I like the way you put that. All right. I would go back. So in this Fed meeting, they're going to update the dot plot, and we're a little bit getting in the weeds here. They generally do that every 3 months, but it's meaningful because it says
Right.
where do they project rates being a year from now, 18 months from now? Okay. So if I go back to what the Fed was projecting back in June, the last time they updated the dot plot, their expectations was for 3.6% Fed funds rate at the end of next year. Okay. Now, Fed fund futures today are pricing the expectation for Fed fund rates at the end of next year around 2.9%. That is a significant gap. And it speaks to your question of the market's kind of arguably saying the Fed is a little bit behind. The market's anticipating that the Fed will be more dovish than previously expected, with 3 more rate cuts, including today, priced in for this year. And if the Fed's sort of updated projections don't move down to reflect that, I guess the turnaround would be, is that going to be viewed as a hawkish stance? Because to your point, the labor market is a big deal, and it seems like their attention has shifted in terms of how much relative importance from inflation toward the labor market. And while it's a bit of a punt, time will tell how that ultimately balances out.
Yeah, I've got a feeling there's going to be an moment after the announcement at 2:00. Yeah, now that makes sense. Kevin, you're in the technology space, which is what the Nasdaq does. How sensitive to the absolute level of interest rates do you think technology firms are?
That's an interesting question. And just as a caveat, I am not an economist. I'm somebody that focuses on derivatives. But from my perspective, and somebody that focuses on the Nasdaq 100, which is certainly influenced significantly by technology, I would argue that broad-based indices across sort of the US and the world are that way as a function of the way that the firms that drive the markets are now, generally tech firms. Now, my take would be that historically tech firms were maybe a bit more sensitive to the absolute rates in the market. But the modern day Nasdaq 100, the index that I help support, is markedly different from like a cash flow perspective from 10 years ago, and certainly from 25 years ago when we were, earlier in our career. These are very large cap companies, and in many cases, they have gigantic stockpiles of cash on hand, and they generate revenues that would make most firms blush. So if you look at like Amazon, Apple, and Alphabet, they're all in the top 10 companies in the US in terms of revenue. Amazon's behind only Walmart. So beyond that, these firms that drive markets writ large in the US and kind of globally now, generally locked in long-term debt to the extent that they even depend on debt back in the zero bound interest rate environment. And if I'm not mistaken, I recall a time not long ago when Apple long-term bonds paid roughly the same as US debt was yielding.
That's right.
At similar maturities. So that's my long-winded way of saying cheap money tends to be a tailwind for businesses of all types. But small cap companies are typically far more levered and therefore exposed to a greater extent to higher or lower rates. And I would argue that the Nasdaq 100 is anything but small cap.
Right. This week we've just released a podcast recording with Tyler Wood from the CMT, excellent technical analyst, and I asked him how firm the trends were looking. What did he see from a technical perspective? He felt that everything remains intact. The bull market's still there until it's not. From a fundamental perspective, do you think that the recent slowdown in the labor market, are you seeing that the economy is healthy enough to drive the stock market higher, or are we heading towards seeing falling interest rates as a panic?
It's a really good question. The way you framed it earlier with like the technicals are good until they're not is
Right.
sort of like how you could frame the labor market. Like it's fine until it isn't.
Yeah, and we kind of had one of those moments as well. That, as I said at the beginning, 150,000
right.
down to 29. It all of a sudden something changed.
Okay, so back to your question and kind of the fundamental framing. I would say that you can make a really compelling argument that the labor market is the key going forward.
Yeah.
And it seems like the Fed agrees. We have seen, I don't think I'm being hyperbolic here, fairly anemic job creation for much of this year, given the huge downward revisions that we've seen more recently to the data. Now, from the investment perspective, like the technical, the markets keep going up. There is a wealth effect there that the Fed historically has kind of relied on and pointed to. But for most people, there is no substitute for income. And we rely on our paychecks to drive what we do day after day, week after week, and drive the economy. And so, in my opinion, the economy remains on stable ground by most measures now. But if we get fairly consistent negative job growth, my concern would elevate pretty quickly.
Yeah, gotcha. Let's finish with a question about options volume. Whenever you do a webinar with me, Kevin, you put up an excellent chart about options volume growth and how how the industry's doing, and it's just been this steady stair climb. Options volumes have accelerated over the years. Earlier this week, President Trump's proposed moving from quarterly to semi-annual earnings reports. Do you think that would have any significant impact on the options market? After all, options primarily are there to hedge, and you can generally hedge over quarterly earnings. What impact, if any, do you think, Kevin?
Good question. One, that's a topic that we kind of bounced around during a team call earlier just this week. It's certainly possible that volumes could wane because there tends to be a great deal of positioning around what we typically refer to as known unknowns, and earnings fall into that category. Personally, just speaking for Kevin Davitt, I like the idea of incentivizing longer term growth for firms. I'm, as you know, kind of a bit of a fan of history. And that was one of the ways that like leading Asian firms grew during the 70s and 80s. They had this longer term plan. And you could argue that some of this managing toward this 3-month reporting cycle disincentivized that. I don't think that like at a top level, they're going to be worried about what that does to option volumes on any given day. The other thing that I would point out, and I have to, or I feel compelled to, because I focus on index options where there's not an earnings report for the Nasdaq 100 or the Russell, right? But we have these regular updates like jobs reports and CPI and known unknowns. And so given the shift in the market and really the broad buy-in for options across the board, I doubt that it would be a very material impact, but I could be wrong there.
Thanks for joining me, Kevin. Are you going to go and have an FOMC party?
That that's what I do every 6 weeks, Andrew. We don't have to tell everyone about that, but yes, I am. I'm hosting today.
Thanks for joining me, and we'll speak to you soon, Kevin.
Sounds great.
And to the audience, thank you for joining me. And remember to subscribe to this channel wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.